Okay, so this video is going to deal with the debt waiver fringe benefit specifically, so it's covered under Division 3 of the legislation. So a fringe benefit arises simply when the provider waives the obligation of the recipient to pay or repay the provider an amount. So you notice here it says pay or repay. So pay, for example, could be my employer provides me with, say, a service, and they go, right, Ben, actually, we don't need you to pay for that. We're happy to give that to you for free. They're waiving my obligation to actually pay for the service they provided to me, so a fringe benefit would arise there. Also then repay, so if I owed the company $10,000 and they go, right, Ben, we love you, we're going to waive your debt. You don't have to pay it anymore, then again, a fringe benefit would arise there. This is really straightforward fringe benefit because there are no exemptions, so simply this just scenario here that we just spoke about when a debt is waived. So yeah, not much to it. So the taxable value for a debt waiver fringe benefit, simply the amount of payment that is waived. So if I owe $10,000 and $10,000 is waived, that's the taxable value. So we've got an example for debt waiver fringe benefit. So Tony, an employee of Ben Limited, owed the company $10,000. Ben Limited decided to waive the full amount of Tony's debt on 16 December 2016. Calculate the fringe benefits tax payable. Ben Limited is not entitled to claim input tax credits for GST. So simply, taxable value is $10,000. We know this because the amount of the obligation which was waived was $10,000, and the taxable value is equal to any amount which is waived. So that's pretty simple. Next, we need to gross up the taxable value. So to do that, we simply take the taxable value, multiply it by the gross up rate. So we know that the question specified we're not entitled to any input tax credits, so that's why we're using the type 2 rate. We know it was in December 2016, so it's for the FBT year ended 31st March 2017, so we'll use the 1.9608. So simply we've got the $10,000 taxable value multiplied by that 1.9608, and so we have a gross up taxable value of $19,608. The final step, we just need to calculate the fringe benefits tax payable. So to do that, we take the grossed up taxable value and multiply it by the FBT rate. Again, because it was in December 2016, it'll be for the FBT year ended 31 March 2017, and so we'll use the 49% fringe benefits tax rate. So simply, we know the grossed up taxable value is $19,608. We multiply this by the 49%. If we stick with whole dollars, this brings us to $9,608 of fringe benefits tax payable by the employer. So that's all that's to it. It's really simple, not too hard at all. So I hope the video has helped.